Hello everybody, this is AK. I'm back. So in today's video, I'm going to address a question that I've been getting a lot of in recent weeks or months, and I think it'll be good to have a video that I can point future viewers or readers of my blog to answer this question. And that question is if I should be buying, or if I would be buying more REITs now, or adding exposure to REITs. So in a comment in one of my blog posts recently gave me that final push to produce this video. And in that comment, the reader said, "Hi AK. Many REITs have recently dropped quite a bit as interest rates are expected to remain higher for longer. CapitaLand Escort has dropped over 11% year to date and is down 6.2% in the past month. At 91.5 cents, dividend yield is about 6.22%. It's also nearing the lows of 88 cents from last October. Seems like recent correction poses a good buying opportunity. In addition to getting a yield of over 6%, there also seems to be substantial room for growth, and we could see price recover back to $1. At 6.22% yield, it is also comparable with what the three banks are currently offering based on their forward dividend yield. DBS 5.8%, OCBC 6.3%, UOB 6%. The banks are generally more resilient than REITs, but the recent correction seems to be a good time to diversify out to some of these REITs apart from accumulating shares of the banks as well. May I know what are your thoughts on this?" Okay, so in reply to that, I think this is something that all of us must be aware of, and I'll say this again, and that is there is a vital difference between REITs and the banks. REITs pay out 90% to 100% of their cash flow to investors. Banks pay out 50% of their earnings to investors. So there's a vital difference there. When we consider this, REITs are not as attractive compared to the banks as investments for income, especially in today's environment of higher risk-free rates, which could stay higher for longer. In fact, it probably would stay higher for longer. That's the narrative. I have been thinking of producing a YouTube video on this, and your comment gave me the final push. So here I am making this video. So if you ask if I've been increasing exposure to REITs, the answer is actually no, right? Ever since the F.I.R.E. stated it was going to increase interest rates to fight inflation, and it increased interest rate very rapidly over 18 months, that we know. Ever since they started doing that, I haven't voluntarily increase exposure to any REIT, apart from taking part in the rights issue by REIT Global. Okay, and why is this so? Because the current environment is not friendly to long-term bonds or long duration bonds or anything that's like a long duration bond, right? And we know that long duration bond or bonds in general pay a coupon, and the bond's value is based on the current day risk-free rate. And if interest rate goes up, bond prices fall. And this is why for a long time I said we should stay away from long duration bonds, because in an environment of zero interest rate, the only direction for interest rate to go up, to go eventually was up, and then bond prices will go down. Okay, and that's what happened. And weaker regional banks in the USA holding many long duration bonds, a lot of long duration US treasuries are actually nursing huge paper losses, and those which had to realize those losses have collapsed, like First Republic Bank, Silicon Valley. Those banks collapsed, right? And when it comes to REITs, REITs are unlike bonds because they do not pay a fixed coupon, but they are similar to bonds in the sense that they are like fixed income instruments. They are similar but not the same, right? I still have a significant exposure to REITs. I moved away from REITs, started moving away from REITs in 2016, and all of us know I started buying into the banks beginning with DBS back in 2016 because I was expecting higher interest rates to come, and I was preparing myself because REITs would get hit, right? When interest rates start rising, REITs would cope pretty well if interest rate would rise gradually, right, in an orderly manner, slowly. But rapid interest rates increase in such magnitude we have seen in the last 18 months really threw a spanner in the works for REITs. And well, interest rates have gone up too much and too quickly for REITs to be able to cope. That's it in a nutshell, right? And for them to be able to cope well, interest rates must not go up too much and too quickly, right? And with interest rates only likely to stay higher for longer, and also possibly increasing further once the Japanese central bank starts tightening, and we talked about this in the video before, the situation could possibly worsen for REITs, right? And like I said in past videos, everything should logically be valued in relation to the risk-free rate. So as risk-free rates goes up, risk assets get repriced lower. This goes for assets held by REITs too, which is real estate, right? All else being equal, it means gearing levels would go up. Gearing levels will go up. This is without the REITs taking on another cent of loan, or they don't have to increase their debt level. Their gearing would go up. This is why I keep saying that if we must invest in REITs in the current environment, we should only invest in those which have stronger balance sheets, right? And that will give them plenty of room for gearing level to increase due to repricing of risk assets lower, right? And I will say that Mr. Market is feeling very pessimistic about REITs now. There's no question about that. And real estate, we don't have to worry about it going the way of the dodo. There will always be, they will always be around. It is not as if we don't need real estate, right? However, we have to be cognizant of the fact that real estate or property is a cyclical sector, right? And REITs might not do well in the current environment, but if they have strong balance sheet, they will be able to avoid collapse and continue to pay their investor, even if the distribution per unit should reduce. Okay, it's just like holding on to stocks of more of income generating equities, right, during bear markets. As long as the businesses are chugging along nicely and still paying us, that's what matters to the investor for income. Those who keep looking at unit prices or stock prices and keep lamenting on how prices are lower, I think they're just torturing themselves. They're just torturing themselves. You know, when it looks like the business cannot make it, that is when I would get out of it, right? When it looks like the business could go belly up, that's when I get out of it. And when it looks like the business is no longer able to pay a dividend, or if they are unwilling to pay a dividend for any reason, and that's when I get out of it, right? And in the REITs universe, we know that some of them have stopped paying dividends because they are unable or unwilling, or they just cannot make it last CMI. Those, forget it, they're basket cases, right? But they were not strong to begin with. Those REITs were REITs that should have been avoided at all costs to begin with, right? For investors, for income, as long as a business is able and willing to pay shareholders, it is better than businesses that are unable or unwilling to pay shareholders. right? As an example, if we had invested in the so-called growth stocks and paid, for example, a price of $300 per share, and it falls to $80 per share, it does not pay a dividend, right? We are worse off in that kind of situation than if we were to invest in a REIT at $1 and that price drop maybe to 50 cents, but fundamentally it's still okay and it's still paying us a dividend. Even if it is a reduced dividend, it's still paying us, right? So as investors for income, we want to be paid regularly. We don't want to be at the mercy of Mr. Market when it comes to receiving income, right? So in conclusion, we have to be very aware of the fact that the current environment is not friendly to REITs. It's the hard truth. We can't run away from it. We cannot deny it. We should not deny it. And we also must be cognizant of the fact that it could actually get worse, right? Which is why I'm not voluntarily increasing exposure to REITs, because this might not be the worst that we have seen, right? And although I'm staying invested in REITs, I'm not increasing my exposure. As an existing investor in REIT, it is easier. It's an easier decision to make to stay invested, because I've already been paid for many years, and in some instances I've already recovered a big chunk of my capital, or in the case of AA REIT, for example, I've recovered all of my capital some time ago. For newer investors, there could be a better time to invest in REITs, right? So that's all. If AK can talk to himself, so can you. Bye bye.